So this is a very important video. In this video, I want to talk about something called as base counting. Now, why is this important? See, I will give you an analogy. Let's say that you are traveling in a train and it's a 10-hour journey. So you board the train. After a few hours, you are going to open Google Maps on your phone to check where exactly you have reached, or where is the train currently in the journey. Have you completed 2 hours, 4 hours? Maybe you slept off. Maybe the train has already completed 8 hours. You just want to check on Google Maps where exactly you are. Similarly, in the stock market, when you buy a stock on the daily time frame chart, it is like boarding a train. However, you need to know where you are in the journey of the stock. Every stock goes through a journey. And the journey that I'm talking about is the stage two journey. A stage two stock is by definition an uptrending stock. A stage two stock is a stock where the 50-day moving average is above the 150-day moving average, which is above the 200-day moving average. The 150-day moving average is not that important. What is important is the price is above the 50-day and the 50-day is above the 200-day. That's a stage two stock, assuming the moving averages are sloping up. In that stage two journey, there are stages. Okay, the stock goes up, forms a base, again goes up, forms a base, again goes up, forms a base. Okay, that's a long journey. And that base counting, when it forms bases, the further you go up, the more is your risk. Because let's say a stock goes from base number 1 to base number 4 or 5, maybe during that time, the stock has already given a 200% move. So you are buying the stock late is very important. That is why this video becomes very important. We are looking at the weekly chart of a stock to see where we are in the journey. It's like watching the train from a helicopter, okay, or watching the train from a satellite camera to see where exactly the train is and where is it intending to go. What's the destination? So you get a perspective. So we as swing traders or position traders, we take trades on the daily chart. But if you want to have a bigger or macro picture, you just have to look at the weekly chart. Remember, I'm not taking a trade on the weekly chart. My trade is taken on the daily chart. But the macro perspective, in what context am I buying the stock? That is important for me. So a stage two stock is divided into early stage, middle stage, and late stage. Okay. And I will show you a diagram in the next slide, which will make it easy for you to understand. So in the early stage, there are two bases. In the middle stage, you have base 3, late stage, you have base 4 and base 5. In base 1 or base 2, base 3, base 4, base 5, you could have two buy points or 2 points from which the stock goes up at least 20 to 25%. Okay. And I will explain this. Every base could have multiple buy points. Moreover, it doesn't end at base 5. So there are stocks which I can show you which go till base number 8. So I am not saying that 5 is the last base. I am saying that after base 3, it starts to become late stage. Okay, you are buying the stock late. By the time stock goes from base 1 or 2 to base 4 and 5 in this area, the stock has probably doubled or tripled or gone up 4 times. I have seen that happen with many stocks. And this base counting is done on the weekly chart, not on the daily chart, which I will explain to you in this video with an example. I have chosen Nvidia as the stock to explain to you this concept, but it can be applied to any market, whether it's India, US, Canada, wherever, whichever stock you are looking at. Okay. Next. See, this is how it looks like. So a stage two stock. See, the stock goes up like this by forming multiple bases. Okay. Base 1, base 2, base 3, base 4, base 5, and so on. It could go up to base number 8. I have seen 8 bases in a stock, and during that period, the stock gave like 300% return. Okay. Now, notice that every base has a high and low. See this rectangle, it has a high and it has a low. This is important. Imagine you are forming a sixth base, and while the price is falling down in the base, when the correction happens, if it undercuts the low of the base number 5, the stock will fall. If it undercuts the low of the base number 4, the stock will rise. If it undercuts the base number 5, the stock will fall. If it undercuts the base number 3, the stock will rise. If it undercuts the base number 4, the stock will fall. If it undercuts the base number 5, the stock will rise. If it undercuts the base number 4, the stock will fall. If it undercuts the base number 5, the stock will rise. If it undercuts the base number 4, the stock will fall. If it undercuts the base number 5, the stock will rise. If it undercuts the base number 4, the stock will fall. If it undercuts the base number 5, the stock will rise. If it undercuts the base number 4, the stock will fall. If it undercuts the base number 5, the stock will rise. If it undercuts the base number 4, the stock will fall. If it undercuts the base number 5, the stock will rise. If it undercuts the base number 4, the stock will fall. If it undercuts the base number 5, the sto So if price falls from here while forming the sixth base, if it falls and if it undercuts the low of this base, that is when the base resetting happens. So that new base becomes base number one. Okay, that's called base resetting. Another way a base can be reset is when the general market falls 20% of the top. So which is defined by Market Smith as a bear market. So as per Market Smith, if a market falls, the general index, if it falls 20% from the top, that is considered to be a bear market. So when that happens, then all the bases in all the stocks are reset to zero. New base counting starts. So which means a stock could have gone up like 4 times, and from that level, the new base counting starts. Okay, so it's not like after 5 bases you miss the opportunity of a lifetime and you will never get a chance to enter the stock. No, that doesn't happen. A stock could go from $10 to $100, and at 100 you could start base counting again from one, base two, base three, but it has to undercut the previous base low. It's very important. So remember, base resetting, there are two criteria. One is it should undercut the previous base low. Second is there should be a 20% drop in the general market index like S&P 500, or in India it could be Nifty 50. Okay, so those 2 points you have to remember. What are these percentages? Well, these are recommended position size. Okay, if you are okay with taking a risk in your portfolio, so these are the position sizes used by champions. Okay, this is not recommended to you if you are a beginner or if you are just learning. If you are just learning, if this stuff is new for you, then I recommend a flat 5% position size, whichever base you are putting your money into, flat 5%, because you will learn with experience. As the days, weeks, quarters, months and years pass, you will learn, you will become good at this with experience, and that will give you confidence to take these position sizes. But these are ideal ones. Like I have seen champions like David Ryan, they would put 20-25% of their portfolio in base one, and as it goes up they would put another 15%. So by the time the stock reaches base two, it's that stock constitutes almost 50% of their portfolio. Say for example, if I put 25% in a stock, by the time it reaches here it could be 30% of my portfolio because of the gain in price, and I put another 15%, so that's like 50%, right? Not 45%, because you started with a small portfolio. So 40% of that initial base of portfolio could become 50% of your entire portfolio, one stock in just two bases, and you still have a lot of runway ahead. Okay, remember, this looks small on the slide, but from base one to base two, if a stock reaches base five, base six, you could see 100%, 200%, 300% move in the stock by the time it reaches base five. Okay, and we'll look at what happened with Nvidia. I think Nvidia went up like 4 or 5 times, and it's not even completed 4 bases. Okay, I will explain to you based on what I have understood on how Market Smith is doing base counting. I have looked at how Market Smith does base counting. I have also looked at how David Ryan is looking at base counting. I have also looked at how Mark Minervini is doing base counting. I have read books. I have listened to interviews. I have done my own research and analysis. I have looked at thousands of weekly charts, and I will give you a simple method today to identify these bases. Use that method, it will help you. Okay, and see, less than or equal to 15% means you can't put more than 15% of your portfolio in base number two. That's the recommendation. You could put 100% of your money if you are willing to lose a lot of money, if you can tolerate that risk, but these are recommended ones. And by the way, the position size depends on a lot of factors. Number one, what is your age? Are you a 25-year-old guy who can afford to lose all of his portfolio, or are you a 75-year-old man, where you can't take more than 5%, 10% risk in your portfolio? Number two, it also depends on how many stocks you have in your portfolio already. If you have like 5 stocks in your portfolio, and it's like 85% of your portfolio is done, then you only have remaining 15% to put in this stock. Number of three, how are your stocks performing currently in your portfolio? Out of five, if four stocks are down, you can't put 25% of your money in a stock because the market conditions are not uh, great. And maybe the stock could be forming a good base, but the fundamentals are not there with the stock. So, the position size you take depends on a whole host of factors. It is not in black and white. So, that is why I have said less than or equal to, less than or equal to, less than or equal to means it could be 10%, 15%, 17%, 20%, whatever you choose to do. Okay, but these are the guidelines. But one trend you notice here, as we go up, the recommended position size reduces. Why? Because the risk is going up. By the time you buy here, the stock is already gone up like 5 times. Like Nvidia, I remember it went from $34 to $140. That's like almost 5 times. And you are not even completed fourth base. I will show you in this video. Okay. So how do you do the base counting? So one simple concept I will explain to you. This is the weekly chart. So three candles below a week's high. This is very important. Try to understand this. Let's say these are weekly candles, and this is the 10-week simple moving average. Okay. So tell me which candle on this chart has a high after which there are three consecutive candles which are below the high. So this candle, if you look at the high of this candle, after this high, there are three consecutive candles. Entire candles are below this high. Okay. That is not the case with other candles. See, if you look at this candle, the high is taken out. At this candle, the high is taken out. Same is the case with all of these candles, but this high is not being taken out. There are three consecutive, like three candles below a week high, not closing. The entire candle should be below the high, and this should happen 3 weeks consecutively. Okay. This is what I have observed when I looked at a lot of weekly charts. Remember, don't confuse this with daily. On the daily, I am looking at 2 weeks of consolidation, but on the weekly, to identify a proper basing area, to identify a proper pivot point on the weekly is not necessarily the buying point. The buying point could be much earlier based on the daily time frame. But to find the proper pivot point, which is the line of least resistance, you can use this method like three candles below the week's high. Okay, let's look at an example. So let's go to Nvidia. So this is the weekly chart. As you can see, I have written W here. So that's a weekly chart. How do you draw the weekly chart? You have the volume. This is the 10-week simple moving average of volume. This is the 10-week simple moving average of price. That's it. It's a very simple chart, nothing complicated here. Now notice the stock is going up here. Okay. And see, this is the stock is making higher highs and higher lows. So this is low. This is a higher 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 low. But you see this low gets broken here, which means the new base starts here. So the base counting starts from here. So let me draw that base for you. You understand why the base counting starts from here, because this low has been taken out. So this is your first base. Okay. So this is the first base. Let me remove, yeah. Let me take this a bit forward. Okay, this is your first base. Now, after the lowest point in the base, forget about this red zone, because red zone is the lower half of the base. Check when does the price come out of this red zone. Okay, when does the price come out? See, on this candle, it comes out of the red zone. So from that candle, you have to check each candle and see which candle has a high, after which there are three candles below that high. So see, this after this candle's high is taken out, this candle's high is taken out, this candle's high is taken out, and so on. Even this candle's high is taken out by this candle. Okay. So the high of this candle is 28. The high of this candle is 28.11. So after the candle after the stock comes out of the red zone, there is not a single candle during this period when the stock comes out of the base. So the stock in this case has had so much demand that it has never seen 3 consecutive weeks of candles which are below a particular week's high. So the stock was showing immense amount of strength. So the stock finally comes out of this base. So ultimately, this candle's high that becomes your first first base. Okay, that was your proper pivot point because that is where the stock came out. So let us call this base. Uh, let's call this base 1. Okay, I will give it yellow color. Okay, so that is base 1. Now base 1, remember this is a very important point. The base 1 has to first prove itself before we start counting base 2. What do I mean by prove itself? Prove itself means after this point, after this yellow line, okay, which was the ideal buy point. Okay, see, I'm not buying on the weekly chart, I'm buying on the daily. But if you look at the weekly, what was the ideal time to buy the stock? Maybe somewhere here or here, right? But here you don't see that high and then 3 candle closes. So that is why I just ignore this price action. I just take the latest one. Okay, so how does a stock prove itself after it comes out of a base before we start counting the next base? So the stock from the yellow line has to go up minimum 20%. So let's go here. So after this, if the stock goes up 20%, see, the stock has already gone up like 37, 40%. So when it reaches that 20%, see here somewhere, within like 6 or 7 weeks, it has reached that 20% distance. I think no, it has already reached here. Within 3 weeks, it has reached 20%. So when it touches that 20% level, not closing, I'm saying just touch that 20% level. When it touches that 20% level, that is when the base 1 has been properly completed or proven itself. Okay, so now we can start looking at the next candle whose high, after which there are 3 consecutive candles which are below the high. So now we can start looking for that special candle on the weekly chart. So let's see here. After this, so this candle's high is taken out. This candle's high is taken out. See this candle. After the high of this candle, there are 3 consecutive candles below the high. Okay, you notice this, the high of this candle, but that high doesn't hold. Again, you get the high after which you have 3 consecutive candles below the high. So instead of taking this high, I will take this high, the latest one basically. Okay, so you can identify which stocks are there, which candles are there after which you have 3 consecutive candles below that weekly high. So I see this is one candle and this is one candle. Even this red candle could be considered a candle after which there are 3 consecutive down candles. But you take the latest one. Okay, this is the high. This is the important point. This is the important point on the weekly chart. So this is the high. Okay, so after this there have been lot of candles, down candles. Again, if you notice, the consolidation happens here. Again, this high fails, the price touches and comes down. So I will look at this candle. After this candle, there are 3 candles below the high of that. After this high has been broken, the stock never looks back. Okay, it just skyrockets. So if I look at this candle, is there a way to, okay, so this is one candle. Okay, after this, the high, there are 3 candles. Then this is another candle. See, after this high, there are 3 consecutive candles below that high, and there is this candle. Yeah, this one. See, after the high of this candle, there are 3 candles below that high. Okay, so out of these 3 candles, which one will you take? I recommend you take the latest candle. Okay, I think the high of this candle is below the high of this candle. So this is 50.55 and this is 50.43. So this candle is a valid candle after which there are three consecutive lower candle. So at the high of this candle, I will put a yellow line which is 50.55, 50.55, and I will call it base number 2. Okay, so I will remove this. Yeah, I will remove these arrow marks. See, now we have base 1, base 2. These were the ideal buy points, or rather than saying buy points, I would say these are pivot points. From there, the stock just took off. After this crossing this level, the stock took off, went up like 40%. If you see from this yellow line to this yellow line, it's like 45%. That's a lot of money. Okay. And from this base 2, now we have to see whether base 2 proves itself. Okay, how does base 2 will proves itself? After base 2, the stock should go up 20%. And see, you can easily see here the stock has gone up more than 20% easily. Okay, within 2-3 weeks the stock is up more than 20%, which means base 2 has also proven itself. Now we have to look at a candle after which there are three consecutive candles which are below that candle's high. And you see, observe this 1, 2, 3, 4, 5, 6, 7, 8, 9. Look at the high of this candle. Okay, 97.40. Let me draw that. 97.40. And the base is, let me call it base 3. See, after the high of this candle, there are three consecutive candles below that yellow line. Okay, so this candle meets our criteria. This one meets our criteria. Okay, and then it forms the base 3. That's the ideal buy point. Then it, as the price breaches that level, now base 3 needs to prove itself. Correct? How will base 3 prove itself? Again 20%. See, it's already completed 20% in 3 weeks. So this is a very in demand stock. Okay, so now we look at the next candle after which there are three consecutive low candles. So 1, 2, 3, 4, 5. So this candle's high, 140.76. So that is base number 4, 140.76. Okay. So after the high of this candle, there are three consecutive candles which are below that yellow line. So the stock has completed three bases. Okay. It came down, bounced off the base 3 pivot point, and it has still not breached base 4. And mind you, remember what I told you here, that by the time you buy from base 1, base 2, by the time you reach base 4, base 5, the stock could be up 100, 200, 300, 400%. We don't know. Look at this stock. If you had bought here or even here, doesn't matter, base 1, from here till base 4, the stock is up 300%. Okay, 302% to be precise. If you had bought on base 2, the stock is up 177.91%. So I am telling you, this base counting is extremely valuable. An important thing is, the reason why the base is not reset is because after base 4 starts to form, this low has not undercut this low. See, I mentioned here, after base 5, let's say another base forms, price starts to come down. If it undercuts the low of base 5, the base is reset. So if this price had crossed below this low, then that would have been base 1, not base 4. But in this case, see it how nicely it bounces from base 3 pivot point. Okay. In fact, that's a pullback trading opportunity, but I don't want to get into that right now. But just focus on what is happening here. So this is how you get 4 bases. Okay. So I hope you have understood what I have discussed here. Start counting from the first base. Okay. You know how to do base resetting now. After this low was taken out, that becomes the first base. So, and from first base, you start looking for candles where after the high of the candle, there are three consecutive low candles. So that's how you draw that yellow line. After the yellow line, the stock should go up 20% for the base to prove itself. Now, base 4, whenever it completes, if the stock breaches that level 140.76, and from that, if it goes up 20%, only then you will start looking for base number 5. But if it goes up like 10% and it starts to fall, then you are again looking for that candle after which you need three candles. Then now that will become your new fourth base number 4. This high will become invalid, and that new candle after 10% when it starts to drop down, that candle will become your new base number 4. Okay, you remember these things. So I hope you got some idea of how to do base counting. I will cover this practically in the videos to come. Now, if you are in India and if you are using MarketSmith, you really don't need to do base counting because they do it for you on the chart itself. If you click on the latest candle, okay, you will, they will write there whether it is base 1, base 2, base 3. It's actually mentioned. But if you don't have MarketSmith, if you are trading the US market and MarketSmith is expensive, then you can use this method to do base counting. So if you are, so let's say you are buying the stock here on the daily time frame chart, you should know that you are buying at base 3. You should know that the stock has already tripled in price before you are buying. Okay, before you buy, the stock is already tripled in price. You should be at least aware of this. Just like you are traveling in a train, you just fall asleep, and when you open your eyes, you look at Google Maps, and you see only 3 hours remaining till the destination. That means 7 hours have already passed. Okay, you were sleeping for 6 hours when the train was running. Okay, so it's like you were sleeping when the stock was going from 34 to 97. The stock has tripled, and now you are boarding the train. So you don't have 10 hours of journey left. You only have 3 hours of journey left. Okay, so from here, from 97, I don't know how the stock could go to 200 and then start to crash. But going from 97 to 200 is very different from going from 34 to 200. That's a huge difference in returns. So I hope you understand base counting. Watch this video multiple times. Okay, if you want another example, I will give you. Let me see if I have drawn the bases. Yeah, see, I've already drawn this base, so this will save a lot of time. See, the stock makes a higher low, higher low, higher low. Now this low gets broken out. This low gets taken out. So that is why I start drawing from here. This shaded area is my first base. Now within the first base, you get two buy points, buy point 1A and 1B. This is base 1, buy point A, base 1, buy point B. Or I would say pivot point A, pivot point B. See, after this candle, there are three consecutive candles which are below the that yellow line. Stock breaks out, goes up 20%, doesn't come below the yellow line. Again, you see this red candle. After this red candle, there are three consecutive candles which are below that yellow line. Okay, so that becomes base 1 buy point B, or base 1 pivot point B. So you could get multiple pivot points. Pivot point is the line of least resistance. Okay, pivot point is where the supply is very low, and if you're trading the weekly charts, that's your buy point. But if you're trading the daily charts, you could get a buy point which is much below that yellow line. You could get a better buy point. Okay, and that we will discuss some other day. But you get two buy points here. Then after buy point 1A, the stock goes up 20%, which means the base has proven itself. Then you start counting for base 2. After this high, you have three candles which are below that yellow line. The entire candle should be below the yellow line, not the shadows, or not the body or something. Entire range of the candle should be below the yellow line. So again, it breaks out, goes up 20%. So base 2 has proven itself. After this breakout, there is not a single candle. Okay, after which there are three consecutive candles here. It reaches here. See, from base 2, till base 3, that's a 90% move. Okay, without a single weekly candle high, after which there are 3 consecutive candles which are below the high. That's a very powerful stock. Now, if you buy the stock here, so now base 3 is broken. Okay, after the high of this candle, there are 3 lows here. Now, base 3 has been broken. Now, base 3, for base 3 to prove itself, it has to go up 20%. And that should normally happen in 2-3 weeks if the stock maintains its strength. Unless it goes up 20%, I am not going to look for that candle after which there are 3 lower candles and which forms the fourth base. Okay. So if you have bought this stock, you should know that the stock has already gone from 4,700 to 13,145, which is a 170% return. We are not even talking about base 4, base 5. Even from base 1, the first pivot point, the stock is up 177%, which is like more than double. It's almost tripled. Okay, we are not even looking at fourth and fifth base. By the time the stock reaches fourth and fifth base, maybe it's from 4,000, it's gone to 20, 25,000. We don't know. Okay, but at least if I have bought the stock here, I should know where am I in the journey. I am at base 3. Base 3 means I am at middle stage. Okay, I could still potentially get a double from the stock, or maybe 200% from the stock. So enough for today's video. Look at this stock, Dixon Technologies, look at Nvidia, and compare, do the analysis the way I have explained to you here. I think this video will help you a lot in many, many years to come. I recommend that you watch this video at least 3 times. I recommend that you go to these stocks personally, go to these charts and personally plot these points and go candle by candle, so that you really understand this concept. Okay, you don't need market smith to tell you how to draw the base properly. You should be able to do it on your own on the weekly chart. And remember, we are not taking a trade on the weekly chart. We are taking a trade on the daily chart based on the volatility contraction pattern of Mark Minervini. But the context is given by the weekly chart. So I will have some coffee or some water now. It's been a long video. Hope this helps you. Thank you so much. And please don't forget to like, share, comment. People should learn these things. Okay, so please help me do that. Thank you so much.